The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening and welcome to the property edition of Your Money, Your Call. I'm Bradley Beer from BMT Tax Depreciation. It's great to be back, this time filling in for Margaret Lomas. In news this week, key indicator of expectations for the housing market has revealed consumer attitudes towards buying a property. Improved from May to June, reversing a 6-month trend to declining sentiment. The time to buy a dwelling component of the Westpac Melbourne Institute Consumer Sentiment Index rose by 11.4% from May to June, indicating more people thought it was a good time to get into the market. The rise was the first time the index has improved since November of 2013. Westpac senior economist Matthew Hassan said that the rebound was a positive sign, but the improvement was tempered by a significant drop in expectations for house prices. House price expectations fell 11.1% in June, compounding a 9.8% drop in May. While those expecting house prices to rise over the next 12 months still outnumbered those expecting declines, nearly a third of respondents now expect prices to be unchanged, Hassan said. The time to buy an index dwelling with a reading of 121.2 in June is still lower than the long-term average of 123.4. The index dipped below the long-term average value in February 2014 for the first time since August in 2012. Broader sentiment stabilised after a sharp fall following the federal budget in May, with about 3/4 of the people surveyed recalling bad news on the budget and taxation, the highest proportion since the survey was started in mid-1970s. At 93.2, the General Consumer Sentiment Index was down 8.8% compared with the same time last year, and well below the neutral 100-point level. Across all measures of sentiment, including those concerning current and future family finances and the economy, the index was lower than the previous year. Hassan said, based on the weakness of the index, Westpac's view was that the case for higher interest rates would not be strong enough until the middle of 2015 at the earliest. And houses are being snapped up most quickly in Western Australia and New South Wales, according to a new analysis revealing the fastest selling markets in the country. The analysis by RP Data revealed that on average, houses in Perth spent only 54 days on the market, while Sydney properties sold after 59 days. By contrast, homes in Perth, Hobart were on the market for 90 days and in Darwin for 90 days too. The fastest growing council in the country was in Perth's Bassendean, where time on the market was as low as 32 days. Bassendean was also the most effective active market for units, with properties snapped up within 27 days. Gosnells, Canning and Victoria Park all made it into the top 10, with houses selling in 42 days, as well as Belmont in 45 days. Sydney's outer regions were also moving fast, with Blacktown, Campbelltown and Penrith all selling within 45 days. Of the top 25 markets with the shortest selling time for houses, 11 were in New South Wales and 12 were in Western Australia. Victoria also got a couple of spots, with properties selling within 37 days in Knox and 41 in Maroondah. For units, inner suburbs in Sydney near the harbour or coast were most popular. Lane Cove, Marrickville, Sutherland Shire, Botany Bay, Hornsby Ryde and Warringah were all highlighted for their quick turnarounds. Nationally, time on the market is somewhat elevated at 80 days for houses and 75 days for units. However, this signals an improvement over the year prior, when time on the market was 94 days for houses and 88 days for units. With me tonight on the panel to discuss these stories and answer your questions are two regulars, Ben Kingsley from Empower Wealth, is qualified property investment advisor, and also Ian Rodriguez, Bishop Collins Accountants, right around the end of the financial year when we're all thinking about our tax deductions. I also look forward to some great property depreciation questions tonight. This week we're making every question a special questions with a copy of Margaret's new book, How to Achieve Property Success, for every caller, providing you email at the end of the show. So if you have a question for any of us tonight on the panel, you can call us right now, 1300 30 34 35, or by emailing at property@skynews.com.au. Welcome to the program, gentlemen.
Thanks, Brad.
So Ben, the consumer market index, a little bit of an indicator of people's feeling in property. Give me some of your thoughts on that.
Yeah, look, it's obviously an interesting time. Property has been performing really, really well. And when you see that type of low interest rates and that type of environment, we're going to see property prices start to increase. And we've really started to see that from early 2013. And Sydney has been such a depressed market. Really, the focus has been on the Sydney market, and it's had some really fantastic results in terms of price valuations increasing over the last sort of probably 12 to 15 months. We go down to Melbourne. Melbourne continues to surprise on the upside. It's had terrific sort of growth periods through before 2006, 2007, then another growth run sort of 9, 10, and now we're seeing another one. So usually those cycles are around 7 odd years apart, but they're a lot tighter. We go up to Brisbane, been a depressed market, it's had some sentiment challenges around floods and so forth, but we're now starting to see that market show some signs as well. And we just heard, obviously, through your spiel there that we've got Perth doing really well as well. So they're markets that are really, sort of holding the fort for the rest of the economy. Then you see markets like Hobart and other areas where unemployment's high and job growth is low, and Adelaide where you've got a strong manufacturing base. So they need to basically change themselves around a bit, and that's why we aren't seeing the same sort of levels of activity in those markets. But that's the wrap-up of Around Australia.
And Ian, interesting point there, it was the budget, and they talk about there was a little bit of a drop in sentiment during the budget because people are worried about the budgets and their taxation, but then kind of spikes again. Do you see sort of with your clients, I guess, them being worried about the budget?
Yeah, look, I think one of the things about sentiment is, it's measured so often. I don't know how much my sentiment changes over a month, but obviously there are people that do, because that's quite some big swings in there. But the general feel we get from clients is that there was definitely a fairly big improvement in sentiment, particularly around business people who are making investment decisions and employment decisions after the election, when there was a little bit of certainty about what was going to happen. And one of the things is certainty is a big issue. Businesses need to know what the rules are. They might argue about what they should be, but it's nice to know the rules aren't going to change. I think the sentiment thing around the budget thing was there are probably a few things in there that may have been a bit surprising. For business, I don't think it was too exciting, but I think for consumers, certainly there's a situation where people probably haven't quite worked out how much it's actually going to hit them in the pocket. And that'll certainly flow through if the budget gets through. And here's another problem we've had for years. We never quite know what's going to happen.
Yeah, I think interest rates was the interesting one for me in that sort of the Westpac saying mid next year before any type of rate increase. So I'm sort of thinking more the end of this year as being the time that interest rates are actually going to move. But if we do see a longer period of low interest rates, because what we haven't seen in this marketplace at the moment is first home buyers. They're just not in the market like they were in the stimulus times of 2009 after the GFC when all the bonuses and boosts came out. They're just not there. So there's a lot of investment activity, and some of that worries me a little bit. But generally speaking, if they've got enough time to digest that the world's okay and economic activity and employment's all right, we might actually see further increase in values over the course of the next 12 months with them driving it as opposed to investors at the moment.
And days on market, I suppose, are an indication they're dropping a bit in general, and I guess that's probably some sort of indication that people are things will sell quicker, I suppose, if they're priced right in markets and they move. Ian, thoughts on that?
Well, I think the market, when people start to argue that the markets aren't really efficient, we sort of lose a bit of interest. So I think, any type of market will operate efficiently. When things are days on market, that could be a whole range of things in my view, but it could be the properties are being priced better. I know you often see properties, you probably see them where you see a property's been listed for years for sale all over the market. And it sort of,
that's great.
Throws the data out.
Well, thanks for tuning in, and don't forget that this week, every question is the question of the week, and your chance to get a hold of a copy of Margaret's new book for free. Ask a question, you'll receive a copy of How to Achieve Property Success, Margaret's complete guide to property investing. Welcome back. I'm Bradley Beer from BMT, and in the studio tonight I have Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accountants. So if you have any questions, you should call us right now on 1300 30 34 35 or email us on property@skynews.com.au. And I have Joe on the line from Adelaide. Joe, you have a question about Christie's Beach.
Yes, hello panel. My question is I'm looking at purchasing Christie's Beach, and I'd like to know what growth the area has in the next 5 to 10 years. And also, I've also got a contract on a property in Christie's Beach at the moment, but I'm just the council valuation is $270,000, and I've got a contract on it for $258,000, and I'm just a little bit concerned that I've been able to get a contract on it below council valuation. That's my question. Thank you.
Well, Joe, as far as the crystal ball on Adelaide, on Christie's Beach for the next 5 or 10 years, we'll get some ideas on what we think about Christie's Beach from the panel. But I might throw a bit of that to Ben to start with. Ben, thoughts?
Yeah, g'day Joe, thanks for the call. Look, when you're looking at any type of location, the things that are critical in terms of the upside over a sustained period of time, and we are talking about 10 to 15, 20 years here, is the lifestyle drivers. So Christie's Beach is obviously a beachside suburb there, and what I'm looking for when I'm analysing those types of areas is what are the growth drivers for that area. So one thing we know is that there's a lot of lifestyle element associated with Christie's Beach. That's great, tick in the box. But then I'm talking about incomes, because it's incomes that's going to drive the value of property over that time. So where do I go to get that income? How quickly can I get to a major employment centre? They're the big ones that I'll be looking for. Now, in terms of your other question around your council rates and the valuation on council rates, don't be perturbed that the council rate valuation on the property is actually lower than what the contracted price is. That is a common occurrence, because usually council rates are done sometimes annually, but sometimes biannually, so they can be a little bit lagging in terms of what the market's prepared to pay. In an open market, if you think you've done your research well, then you're going to know that you're paying fair market value for that. If you're not, then go and get some comparative prices and compare the two assets to the location that you're in, and sort of focus in around that sort of 500 metres from the property, and make sure you're comparing apples with apples. So brick to brick, weatherboard to weatherboard, those types of things. But in general, Christie's Beach, Adelaide does focus on the coastal community. It does have more of that sort of driver as opposed to a latte sipping culture in that particular market. And that's something that I'd be saying, look, it requires further exercise in terms of doing the research, but ultimately it sounds like something that I'd look at.
Thanks, Ben. Great advice on Christie's Beach there. And I think with Christie's Beach, Margaret's been quite positive on Adelaide for some time, and lately I don't think it's had much growth or much movement. However, I am hearing a few more positive things going on around in the Adelaide market at the moment. So thank you very much for that. Thank you very much for that. And we have Eddie on the line. Eddie, you're from Sydney. We want to talk about a townhouse in Liverpool.
Yes. I just want to know, like, is it better to buy a townhouse or a unit? And I also want to know the rental demand in that area, as well as the long-term capital growth.
Well, two parts about that question, Eddie. We've got townhouses versus units, which is always a debate, townhouses versus units, and also houses, I suppose, and capital growth in that area. Once again, I guess we're looking at crystal ball land, but probably Ben, once again, your thoughts?
Sure. Thanks for the call, Eddie. one of the things you need to understand is what's the underlying intrinsic value in what you're buying. Now, in a townhouse or in a unit development, it's actually the land content that's appreciating in value. So we talk about a land to asset ratio. So when you're buying a townhouse, you might have a land to asset ratio that's greater than when you're buying in a unit block that might have, say, 30 or 40 units. So with a townhouse, you might get 1/6 of the land value, whereas with a unit block, if there's 40 in the block, you might get 1/40th of the land value. So from a technical analysis point of view, townhouses will usually outperform units. Where that question is then get a bit grey or a bit muddy is what if that unit is better located than the townhouse? So a lot of people can sometimes make the mistake to think that I'll go and buy a townhouse or a house in a suburb that I think I'm getting more value for the actual improvements or the construction on the land as opposed to actually buying in the better area. So when you're buying in a better area, you potentially get the more capital growth because there's more demand. People want to live in that location, and that's where you'll get greater growth. I hope that answers your question, Eddie.
And thanks, Ben, and Eddie, I hope that gives you some insight there. I also think, you know, we've got townhouses versus units versus houses. It's obviously a common debate in property investment, and I think a thing to really consider is what people actually want to live in that area, and making sure that they do. It is the right thing. Some townhouse might have a little bit more maintenance for someone than a unit, and in particular areas, some people don't necessarily want to live in a townhouse in that situation. Now, I think, you know, being a situation where, you know, houses also can make a difference to this. I think, Ian, you know, townhouses versus units, what do you see your clients most of the time investing in?
We've heard this question, you know, time and time, and, you know, what's going to be best, but it really depends. It depends on the market you're in. It depends on where you're buying. So, you know, a unit block where everything else is on acreages probably doesn't really look that good. I don't think you see that often, but
to give Liverpool, Ian, what's your view on Liverpool?
Oh, Liverpool seems to be all units down there, so if you can find a townhouse, it'll certainly be a plus. I think you'd be in a different price range though, wouldn't you? So, yeah. But Eddie's looking in the right place, I figure, but I'll leave it to the others.
And I think that we're in Western Sydney, where we've had a fair bit of movement in that market, guys, and I'm starting to hear little bits of, you know, not so positive information. But then we're having airports going up, and then I hear both sides of that story. There's a boom and or a bust every second week in the newspaper. I read quite a few more bust stories on the weekend, actually, and it's an interesting situation that we tend to have that. One week boom, 1 week bust, whatever's the best headline. And once again, the weekend, lots of that that we did have. Any further thoughts, Ben, on?
Yeah, look, general commentary does take a situation where you're getting mixed messages and a lot of noise in the marketplace. I come back to the outer suburbs of Sydney, and our analysis on the outer suburbs in Sydney is that you're seeing 10 years of soft growth, and we're just chasing our tail. We're just picking that up. So affordability is starting to get to that level. So I still think there's a little bit left in it, but ultimately, you know, over the medium term, I think it's going to be okay.
Now it's time to take another break, but if you do ask a question, you will receive a copy of Margaret's new book, How to Achieve Property Success. All you have to do is call us on 1300 30 34 35 or email at property@skynews.com.au. Make sure you watch at the end of the show so you can see how to get a copy of your book, and we'll be right back. Welcome back. I'm Bradley Beer, and in the studio tonight I have Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accountants. So if you have any questions, you could call us right now on 1300 30 34 35 or email us on property@skynews.com.au. Now, our first email tonight comes from Jeannie, who's asking about property markets in Sydney and Melbourne. We are from Sydney, so we do not know much about the property market in Melbourne. Can you kindly suggest any comparable suburb that has growth like Southwest Sydney, the Ponds, Schofields, and do you think it is still a good investment in the Southwest at the moment, or any other suburbs in Sydney that you would suggest to look into? Now, Ben, a little bit of comparison between, I guess, Sydney and Melbourne there that she's asking about. Your thoughts?
So, Jeannie, it's an interesting one for me because those areas that are really taking off in Sydney are all about the train infrastructure. So it's the northwest rail line, it's the southwest rail line. And if I try and draw comparisons around what's happening in the Melbourne market, there's no rail under construction at the moment. So with no rail under construction at the moment, I don't have those sort of similar comparators. Yeah, because what's actually happening is that people are saying, I'm happy to live in these outer suburbs, but I can get a quick commute into a city centre. And that, from an investor's point of view, that's what we're looking for. We're looking for people who can earn the bigger incomes by getting to a larger employment centre quickly. And in Melbourne, we don't have any of that. Now, there are some projects that are in the pipeline under feasibility at the moment, and those projects are things like the airport connection or a new rail line from South Yarra that goes around through into the sort of areas of Docklands and down into Fisherman's Bend. But these are projects that may not come online from the start of 2017 to 2027. So right now there's not any sort of similar comparisons to what I'd be seeing in those markets in Sydney, where we're actually seeing those rail lines come through.
Ian, anything to add to that?
Yeah, well, just, I mean, the logic is around Sydney, you only got to drive around there to see the rail infrastructure going in. There's a lot of other plans in place, and we've still got an airport on the to-be-delivered list, which seems closer than it ever has. So it would be very interesting to watch the markets.
Now we have a caller on the line. I have Lorraine here from the Central Coast. Lorraine, you're from the Central Coast, and you've got a question about Muswellbrook.
That's right, Brad. Thank you very much for taking my call tonight. I do have a question. We have had an investment property in Muswellbrook since 2010, and it has performed very well. Although at the moment our house is vacant, and the vacancy rate up in that area is at 10% more, plus, right? And so we're having trouble renting our house, and our competition is a lot of the brand new houses that are being built. There's a developer up there that has a 32-stage of land development, and he's only up to stage 16. So we've got big concerns about how to get our house rented.
Yep.
And plus, moving forward with Muswellbrook, is it something that, is ever going to come back again, or, like we can't sell it at the moment because we wouldn't get what we paid for it probably. Yeah, we just don't know what way to, how to move forward.
Right. Lorraine, Ben, your thoughts on Muswellbrook?
Yeah, look, Lorraine, it is a story of a cyclical movement that's happened in terms of the mining centres around Australia. It's a coal story, and it's a story that's not boding too well for investors in those particular marketplaces. What you'll see is the new developer won't actually be able to complete all their stages of development unless there's significant upturn in terms of the economic activity around coal and mining in general, and coal steam gas. So it's not a good story for you, unfortunately. I wish I could tell you a better story. The questions that you want to be looking at is to talk to your property manager. There may be some incentives that you may need to offer as part of attracting a tenant into that property. And you've got to look at your asset and say to yourself, what is it about my property that separates myself from the new assets? Some of them could be larger sheds, larger parcels of land where they can park their trailers, their cars and those types of things. You've really got to look to sell that. And you've got to be telling your property manager that don't just show people through, tell them you've got a great property for them and you're looking to do a deal on the property. That's the best way, because you're right, you don't want to be selling in this type of market. And it's a warning to all of our viewers in terms of buying into these mining centres. The upswings are fantastic, but the volatility in these particular locations is real. And if your timing is poor, you can get hurt. So all the best with that inquiry, and do well with your property manager.
And Lorraine, I think some good advice there. Often the ability to rent your property does come down to your price versus other properties, and I think making sure that you are the first one that is there so you can get some rent rather than none is something you've got to look at, and then look at the bigger financial question of potentially selling that property if you can't afford to hold it based on the rent that's there. Now, thanks for watching. It's time for a break, but when we return, we'll be answering more of your questions and giving away more books. Simply call now on 1300 30 34 35, or you can email us on property@skynews.com.au. Welcome back to Your Money, Your Call. Property Edition. I'm Bradley Beer from BMT. It's been a pleasure to have on the panel tonight Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accountants. Been busily answering your questions, and if you have more, call us now on 1300 30 34 35 or email us on property@skynews.com.au. Now, Anil's email is a tax question, perfect timing with the accountant Ian Rodriguez on tonight's panel. I was hoping you can help me with the following tax question. I have 2 investment properties with interest-only loans. If I use my line of credit to pay for my insurance and council rates, is the interest incurred on the line of credit tax deductible? I have no personal non-deductible debt and always make the interest repayments from my rental income and my salary. Now, Ian, we have lots of tax questions and we're right at the end of tax time of year, so do you have some answers for us?
Well, I think the first thing to say is interest deductions are the single biggest issue the tax man has. The tax woman, or be corrected by Margaret, so, but the tax man has a big problem with getting interest deductions wrong. And the particular question there, I'd always recommend get advice from your accountant because everyone's circumstances are a bit different. But in general, that whole idea that you pay the interest, pay the costs like council rates and other things, from the one line of credit, as long as you're paying the rental income over, is generally okay. There have been taxpayers that have tried to, let us say, push the envelope and argue that you can do a bit more than that, and some with success, you know, and arguably they can, depending on their circumstances. But in a general sense, the answer to that question is yes, they can claim the interest on those things. This goes back a long way. I had to go back and, you know, there was a case, Hart's case some time ago. It's all about Part 4A, which is anti-avoidance provisions. Most taxpayers don't end up there. So I'd say get some advice, and if you're going to have a try claiming anything more than what the email had, I'd be very careful about that. But what the email had, I'd certainly very comfortable with.
And look, the Hart's case is something that is well known, and I think it really often comes down to the fact that you've got to be fair and reasonable with these things and make sure you do stick by the actual rules that are there, rather than sort of, can I do this and do fancy things in order to try and really avoid tax, when really what we should be doing is only doing the things that do relate to the proper things that do relate to the tax return.
I think most taxpayers' risk-taking behaviour is actually far less when they have the tax person across the desk from them. So, you know, if you're not prepared to get in and bat for it, I'd take the more conservative view, and that's the advice we'd give to all our clients.
Now we have Katrina on the line from Melbourne, and Katrina, want to talk about setting up a trust. So while we're in the tax part of the show tonight, I guess, Ian, that's probably a question you can ask us right now, Katrina.
Hi there. I just wanted to inquire. I'm very soon going to be hopefully a first-home buyer, and I'm just wondering regarding a trust. 2 questions within it: whether you think that would be the best thing to secure the property, basically so that no one can take it later on, and do you know whether there is an extra cost if you are to do that now when you purchase the property or later on in life? Thank you.
Okay, good questions. Thanks, Katrina. I guess one of those is really around protection of that property, Ian, for future, and the potential to change from one entity to another. So, Ian.
Well, you've got to remember, you're only going to using a trust if you want to protect assets. It's only really to protect them from, not from the bank, because they've got charges over it. It would be from what I'd consider the unworthy creditors. So if you're in a high-risk business where, as a director, you may be liable for things and insurers don't want to pay up, and, you know, very risky business operation, you want to make sure assets aren't in your name. So it could be in a non-risk-taking spouse's name or in a trust, is often the way to do that. Self-managed super is a trust, just different rules apply. Asset protection is only one issue. Katrina mentioned restructuring later. We'll be really careful there, because you're talking about moving it, you know, from one name to another. You've definitely got capital gains tax to consider. You've also got stamp duty to consider. So they could be major costs to restructure. So trying to get it right from the start is the way to go. Apart from that, the biggest thing people forget about with trusts when setting them up is land tax. So the general rule is, in particular in New South Wales, no threshold. So in New South Wales, the threshold is $400,000 odd of land value that you don't pay land tax on. a trust gets no threshold. So a threshold is worth about $6,500 per annum in land tax. So it's a big call to set up a trust. Katrina said this is her, I think she was a first-time asset buyer. So you'd seriously want to think about using up your land tax thresholds before you went to a trust.
Yeah. And Ben, I think Katrina mentioned she's looking to be a first home buyer. And do you see many of your clients that probably buy in trust as a first home buyer?
No. And, you know, we do hundreds of strategies a year for our clients. The reality is, again, I'm with Ian on the question of complex structures. Do we want to set these complex, which are also quite costly? I have a couple of them myself, but I'm in a risk business, you know, so I'm protecting the assets in my family. So in terms of if you're being pitched or sold to as this is the perfect structure, go and get a second opinion on that, because, I mean, each one's going to cost you anything between $2,000 to $2,500 a year to manage. So from my point of view, and Katrina, from your point of view, asset protection shouldn't be the only thing. If the asset's managed well and you put all your insurances around, you know, landlord protection insurances and building insurances and so forth, the question for you has got to be a broader question. If you're self-employed, sometimes it makes sense, but usually for our clients, we tend to move through and buy it in our personal names.
And I think, Katrina, I agree with a lot of that advice there. The fact that you are buying a first home seems odd that a trust seems to be what is suggested to buy that in. Once again, it really depends on the type of the business or type of job you have and the risk involved in that. I also agree with. And some other advice as a first home buyer, we've got, you know, think about future capital gains tax and what differences a trust might make to that for you. It's a very complex sort of question that you may need some further accounting advice on. Now, Ian, I think back, we've had a bit of a tax segment here, and probably a question for you probably runs around, you know, we're coming up to 30 June, we're in the middle of June, and it's the time when people are doing a lot of their tax planning. And a couple of your top 3 tips.
Top 3, yeah. There's look, the biggest single, you know, expense on a property is, of course, interest. So if you've got properties in your own name in a structure where you can prepay interest, so you can prepay roughly a year ahead, that brings forward the expense. But once you prepay interest, you're on a bit of a treadmill. You've got to do it again next year and those sort of things. So look, prepaying interest, if you can do it, not all taxpayers can. Is a good one. It's a big deduction, helps out with cash flow in bringing the tax deductions forward. The other one that sort of plays off that is refinancing. So if you've got borrowing costs that you're writing off over 5 years, if you're thinking of refinancing, changing those loans over before 30 June can help you write those borrowing costs off once that loan's terminated. And also the bigger one around that is people who've got fixed rate loans. So if you've got a fixed rate loan and are thinking about breaking that fixed rate, well, I'd rather do it before 30 June and get the deduction for the break cost. So that helps a bit tax-wise.
Look, very interesting. I'm in the throes of actually refinancing a few properties at the moment, and they're waiting on some more information for the lender to finalise those. And I didn't really think about the borrowing costs being trying to pull some of that, make sure it happens pre-30 June. Like I live in a business where we do depreciation schedules, and we're always sort of make sure you get depreciation sorted out. 30 June's coming up, and very important sort of time of the year to think about that. But
well, of course, the fee to do a depreciation report is tax deductible, so I'd certainly want to pay that before 30 June. You don't need the report till you lodge your tax return, but the fee to prepare it, of course, is
it's a regular question we get. So, well, what if I don't get it done before then? We'll do it before then because you get the deduction, but the deduction for the depreciation is still relevant actually in that in that financial year when you actually owned the property and produced income from it. Well, thanks for being with us. We're off to a break, but when we return, you'll have another chance to ask questions of our panel simply by calling us on 1300 30 34 35 or emailing us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Bradley Beer from BMT, and joining me tonight on the show is Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accountants. They're both standing by to take your calls now on 1300 30 34 35 or email us on property@skynews.com.au. Now we have a caller, Vince. And Vince, you want to ask us a question about Townsville?
Oh, hi. How are you going? Yeah, just about Townsville. I actually moved from Melbourne to up here in Townsville about a year ago. I've got a house and a investment property in Melbourne. I was thinking about selling the house. Both of them are rented at the moment. So thinking about buying up here, but to do that I need to sell one of the properties in Melbourne. So just wanted to know your opinion on Townsville, whether it's, worth buying up here, because I was thinking about staying here at least about 5 to 10 years.
5 to 10 years, okay. And you need to sell the properties in Melbourne to purchase into Townsville, Vince?
Yeah, that's right.
Yeah. Ben, thoughts on Townsville and selling in Melbourne?
Thanks for the call, Vince. Look, Vince, can you just let me know where the properties are in Melbourne? You still there? No. Well, anyway, I'll answer the question, and that is, I've got to give a broad answer here because I don't know the facts around where the assets are located. But I will tell you this, and I say this to all people that I'm advising, selling a property is an expensive exercise to get back into the market, and I'll explain to you why. Usually when we buy a property, it costs us 5% in stamp duty. If we add interest for the first 12 months, that's our true cost for the year. So we're up to about 11%. If we then want to sell a property, there's another 2%. There's 13%. Buying a new asset is going to be 5% in stamp duties again, and then we've got to look at the value of that asset. So we need over a 20% turnaround in terms of the actual return on investment. So, Vince, I'd be saying for 5 or 10 years, property is a long-term investment. If those properties are well located in Melbourne, you're looking at a city that's a global city, in the top 100 cities by population. So I would suspect that unless you can see the reasons why Townsville's going to have an economic boom, you may still be well served by renting in a marketplace where vacancy rates are a little higher up in Townsville at the moment. You might get better bang for your buck by retaining those assets in Melbourne. But again, I'd need to see more about what those particular properties are and what your long-term strategy is. But looking at Townsville, I don't have any great problems with it, but I still think there's maybe better opportunities in other markets. And I know Margaret's big on that in terms of talking about just because you want to live in a location, if those assets are performing well in the Melbourne market, it doesn't mean you have to just shift them over.
Ian, any thoughts on Townsville?
Yeah, not particularly on Townsville, but this has got an issue that I think a lot of people face, and that is you may have properties that are now geared and you're looking to live somewhere. You're either faced with non-deductible rent, or do you borrow money to buy somewhere to live? Because you need to live somewhere, and you may not want to rent. If he does that, he's got a big non-deductible loan in Townsville. It may in fact be a 100% loan to buy, and he may have a lot of equity in his Melbourne properties. And going on what Ben's just said, I mean, it becomes a real challenge, a mathematical and a finance challenge to decide whether you actually take the pain of selling to pull some equity back.
And you can model that.
A new home.
They're complex models, but you can model it. So you can sit down and run some scenarios and see what type of investment returns that you're looking for. And the answers are always in the numbers.
That's right. Yeah. So it is a real challenge for Vince. So
great. And Vince, I own a number of properties in that, and I actually rent where I live, and I do that because I choose to live in something that's probably a bit more expensive than I'm buying as investment properties, and so. If you really want to buy in Townsville, the fact is that, if rents are softening, as Ben says, and it's probably not a bad time to rent in Townsville. But then looking at, if you don't, believing that the Melbourne's probably having some potential for good growth over the near future, maybe there's more money to be made by hanging on in Melbourne without incurring all of those costs potentially, and looking at renting in Townsville at a time where the market possibly has been a bit softer. But then it's all really about crunching those numbers on seeing if I do sell those, what do I end up with after I pay the taxes and things and the costs of getting out of that property. And sometimes people really just want to buy a house that they can that they can live in. Now we're going to move to Harry from Sydney, and you're on the line, Harry?
Hi guys, thanks for taking my call. I just about to complete a subdivision in the Sutherland Shire from 1 block into 2. I'm going to put 2 brand new houses on it. Firstly, will I be able to get good depreciation out of it for the first few years and things like that? And also, am I entitled to any government grants because they're brand new houses?
So, Harry, I can probably talk to you about the depreciation question, but anything on the government grants, guys?
No, I'm not too sure what grants he's referring to. I'm not sure that they've been.
In Queensland, there's a $10,000 grant for anything new. But if you're constructing it yourself, Harry, that's one thing that I would just have some investigations on. I know that the New South Wales budget's about to come out shortly, but the subdivision's the more important one, and that is, you know, separating those land contents and what the treatment from a tax point of view, because that's probably the bigger question here for me.
Yeah.
Yeah, and Harry, being brand new properties, you're building on that site. Depreciation in newer properties is usually the highest it's going to be, because the value on the items and the things that you put in that property, and also the cost, has all just happened now, and things are actually new. So, you know, old property still gets depreciation most definitely, but when it is new is when you're actually going to get the most out of that. So you want to make sure you treat those costs properly and get the maximum depreciation you can from that.
The other thing for Harry to keep a real close eye on is his GST. So a lot of people, when they're building new houses, don't plan for or properly allow for the GST. So if he does change his mind, decide to sell those, he's got to factor that into the selling price and all those types of things. And certainly the 5-year rule, where if he's held it, rented them out for 5 years, the GST liability changes completely. So it's no longer considered new residential. So, Harry, you do need to get some good advice on the GST just to make sure you're fully on top of those. So,
I think a lot of that actually comes down to what you intend to do with the property. If you're a developer and you're selling these properties,
totally different. Totally different. It might be trading stock.
Yeah.
So that's why I say there are so many variations. Just to make sure he's on top of it, because if, you know, the number of people that I see sort of not thinking about it, it's a bit of an afterthought. And you really need to make those decisions when you're lodging your BAS return as you go along.
Yeah.
So, yeah, very important to get it right.
Look, Harry, I also personally have been doing a couple of small developments, and it's such a relevant question. I'm a depreciation expert, and my accountant's seen some things in my tax return saying, "What are you doing with this?" And I said, "Well, I'm building." And he said, "Well, are you selling?" And I said, "Well, no." He said, "What are you doing with the GST?" So it's you know, it's something that sometimes you think, you crunch all the numbers, and I have every intention to hold, but my accountant even asked me exactly the same question about properties that I was developing when he started seeing invoices come through in my tax return for DAs and things that were going on. Well, thanks for tuning in. It's time for a break, but when we return, we'll take some more calls and emails. Simply call us now on 1300 30 34 35, or you can also email us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Bradley Beer from BMT. It's been a great night with my experts Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accountants. Been busily answering your questions. If you have any more, please call us now on 1300 30 34 35, or email us on property@skynews.com.au. Now, we often have questions about finance on this show, and Michael has an email, and he's from Brisbane. I'm interested to know your opinion on cross-collateralisation. What are the pros and cons I should consider when starting a portfolio? Now, you know, cross-collateralisation is a regular question, lots of finance questions, and I think a lot of different people have different views on this, so we'll get an answer from both of you if that's all right. So, Ben, you first.
Yeah, look, and just for the viewers' benefit, cross-collateralisation or cross-securitisation, as it sometimes be refers to, is referring to the bank taking joint security over the lending that they're offering. Now, the positives of doing such a thing is the ease in which you can set your structure up. So you don't need to have lots of loan splits. You can have them under sort of master or global facilities. But the negatives of having cross-securitisation is you're putting all the control in the bank's hands. Now, by putting all the control in the bank's hands, what's actually happening is, let's say you've got 5 or 6 properties, and let's say 2 of them have done really well, and then you've got the other 4 that haven't done so well. Well, if they're all cross-securitised, what's actually happening is the bank's going to value all 6 of those properties. Now, the 2 that have had great results could be hampered by maybe a downturn in one of your mining town properties or whatever it may be. So having them uncrossed means that you're able to focus on the ones that have got the equity and release that equity so you can continue on your wealth accumulation journey.
And Ian, your thoughts?
Yeah, it really depends. I mean, I've seen situations where it makes absolute sense to allow it, and I've seen situations where you're trying to asset protect or do things differently where you want to keep it separate. So there's a whole range of issues to consider. So I don't think there's ever a you know, yes or no, and anyone arguing, you know, one's good and one's bad, it depends. I've seen situations where it depends on, you know, what the client needs to achieve.
And look, I think very good point, Ian. It comes down sometimes to yourself and what you're doing in your situation. Now, I've you know, probably been fairly against in my personal investing cross-collateralisation of my properties. Now, I have done it once, and it probably was the one that did actually burn me a little bit. And I think the reason I generally don't like is because it just takes away some flexibility. I tend to be someone who likes a lot of flexibility in my investing. I like to be able to change what I'm doing, and having them cross-collateralised means that sometimes the bank has sort of them joined together. Sometimes I think the benefit of cross-collateralising the properties, though, is that when you do want to refinance and pull out some of that equity, you can pull it all out of the total value of the properties, as opposed to you can't refinance and pull out these little bits out of properties if they're not cross-collateralised. I had one that sort of went down a little bit in value and probably wanted to separate it and couldn't refinance the other one, so that's where I got burned. But I think both times there'll be situations where cross or not cross-collateralising may be positive for you. Now, you guys, have you generally cross-collateralised or not, Ben?
No, I'm uncrossed on all of my investments, and that's the way I like it. Even though there's more administrative work, because effectively you're releasing 20% or 25% of that asset to secure it, so you're not paying mortgage insurance on the next one. So you might have two splits, and then you've got to remember the relationship between what, you know, the purpose of that money and making sure that that's relating to the interest deductions on this home. So most of the work we do is uncrossed. But in terms of, there are examples where it has worked in terms of actually crossing them, and one might be where you know, they're upsizing or downsizing in a family home, and so you put them together and you can then refinance, but then once one of them's released, you can actually then reduce the mortgage, and it's less work in terms of how putting it together. So it can work.
Look, a regular question that's always asked, and it really comes down to the personal situation and how much that's going to affect the particular person. Now, look, that brings us to the end of our show. That was quick. Margaret will be back next week, and joining her will be Noel Petra-Healis from my company, BMT Tax Depreciation, so more depreciation questions there, and Rich Harvey from Property Buyer. Thank you to my guests, Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accountants, who will be, of course, be back again very soon. Thanks also to our callers, and now as a caller, you can take advantage of the free copy of Margaret's book, How to Achieve Property Success, special she did for us tonight. To do that, you just need to email your money, your call at destiny.com.au, and Margaret will send you a copy. You can also get a hold of a copy of this yourself from a good bookstore or online at destiny.com.au. Thanks for being with us. I wish you all the best for your property investing journey. Look forward to seeing you next time. Thank you.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.